Hello, I'm Michael Wildeveld with Exit on Your Terms. What are your exit options? The reality is you have more exit options than you probably realize. We can look at everything from kind of the worst case to the best case scenario. Worst case, forced liquidation. Creditors come after you, force you to sell off your inventory and your assets for pennies on the dollar. Might bring you 10 cents to 20 cents per dollar for everything that you have. It's an option. Not particularly attractive, but it's an option. Second one would be organized liquidation, where you have the time to sell your equipment, sell your inventory, and recoup either its value, maybe even make a profit on it. Again, not that attractive, but an option. After that, we'll look at internal sales, or even internal transfers, let's say. First, succession planning. You might have a family member that you're going to give the business to, whether you gift it to them or sell it to them. Could be, kind of how you choose to transfer it, but those are folks that are near and dear to you, and it's oftentimes what you see in family businesses. You then have your internal team members with the company. That could be a management buyout where your management team gets together, raises the capital or gets a loan to buy the company from you. Or it could be a management buy-in where other folks are coming in, they're buying in, and they're going to move forward with the rest of your staff. When we're looking at the internal transfer channels, we could also look at programs like an ESOP. There's different variations, but let's use an ESOP as the standardized employee stock ownership program. This is where your staff are basically taking over the company. A little more complex than it sounds. They're not directly buying it, but a trust vehicle is purchasing it. The trust is representing them. Nonetheless, it's an exit option, and frankly, it has tremendous tax advantages. You probably want to be making, the numbers tend to be, let's say, $1.2 million to $2 million in EBITDA, where it depends a lot on make economic sense for you. And that's part of because of the administrative cost, the cost of setting it up, and where you're going to get the most tax benefit, and the company is going to get the most tax benefits going forward. You'll also want about 20 plus employees, typically in certain industries. Figure a lot of service industries are good examples. Manufacturing could be a good example. But there's a lot of nuances to it. If it's for you, it's great. It's not for you if you typically want to get the highest dollar value, as is the case with a lot of internal transfers. If you don't want to be on a personal guarantee or potentially participating in the leverage that's going to be raised to acquire the company from you, or if you want kind of a clean exit on day one, these typically aren't going to provide you that. The good news is with an ESOP, people think it's all or nothing. It's not. You can stick your toe in the water. You can start off with 10, 15, 20% selling to the ESOP, getting the tax benefits just from that, but then taking some of your chips off the table, getting liquidity, and kind of exploring what it looks like. The real advantages are going to be when you trade or sell 100%, but you don't have to do that on day one. You could stage it over time, which most owners do. When we go from first, again, liquidation, second to internal transfers, next is going to be external transfers. So these are the sales that a lot of people think about. Third-party sale might be the most common one, where somebody's going to come, step into your shoes. Typically, that'll be an individual. They're going to look and smell like you, maybe have similar background. Might be a family. If you're a family operation, it might be a family coming in where it's spouses and children involved in the business. That's pretty clean, straightforward. Oftentimes, they're going to not have the cash to write you a cash offer unless it's a smaller business. You'll find they're going to ask you for some seller financing. Maybe they're going to raise capital through an SBA loan, so they'll provide a 10 to 20% equity injection or even higher. The bank's going to finance it, and you might be asked to carry 10 to 20% of it in certain circumstances. Very clean, very straightforward. It's what a lot of smaller businesses have come to expect. You're going to get paid most of your money at close, have a clean transition with maybe a 2-week to 2-month transition period, depending on the type of business you're in. Fairly simple. SBA limit's about $5 million. That kind of gives you where the threshold is on how much you could sell for, how much they'd raise in capital. Figure $5 million can get you to a $6 million sale, putting a $1 million equity injection into the deal. After that, we're going to start to look at private equity type of deals. There's subsets of private equity. So if we say here's the gamut of possibilities, we have the growth funds that are looking to come in, buy a company, and maybe have a longer holding period. The same thing, let's say, with a family office. That's a wealthy family that's already established their own private equity fund. They don't need to turn around and pay back the limited partners that are their investors in the typical 7 to 10 year horizon. And then depending on where they're at in their cycle, they might only have a hold period with your company of 5 to 7 years. So family office could be attractive from that standpoint. Or the more financial buyer, that's the private equity company most people think about. Those are the folks that have raised a fund. They're going to put down a percentage. They're still going to raise debt. Figure the debt to equity benefit is maybe 3-to-1 in terms of the returns they're going to get. So even if they have the capital, they're still going to raise debt because it makes more economic sense for them given what they have to pay back their investors. These folks are going to come in, they're going to try to grow your company, they're going to financially engineer it, and they're going to try to exit for the most that they can, oftentimes with the target of at least 3 times what they entered the company for. So oftentimes people think they're going to be aggressive, they're going to cut costs. Could be true. Doesn't mean it's going to kill your culture or get your staff fired, but it also could be the case. If you're a platform company and you're large enough to be a single investment that they're making in your industry, and you can hold your own on a standalone basis because you're making that 3 to 4 million in EBITDA, they might hold you through the whole hold period of, let's say, up to 10 years, and then purchase other companies that are much smaller. We call those add-on acquisitions. There's different types of add-ons. There could be a tuck-in, where basically your company's kind of fold right into their company. Your name goes away, your legacy goes away, your staff probably goes away, but some of your products, sales channels, assets will just fold into the larger entity. There is a bolt-on, which is, think of that as the main company, and then you're the little satellite company that's next to them. If that main company oftentimes will be doing at least 5 million EBITDA, if you're doing 2 to 3 million, you're going to be an add-on to that. You might keep the name, the staff, the legacy. They might make or create efficiencies through back office, sales and marketing, delivery, fulfillment, all that good stuff. But at least your company tends to still be alive, staff stays employed, and there's still kind of some legacy aspect to what you created. And then there's everything in between. There's no one thing or the other. Back to different sales channels, we're talking about private equity. Something else that could happen is what we call private equity recapitalization. It's kind of what I've already described. That's where private equity is buying your company, but typically they're going to buy, let's say, 80% in a majority recapitalization. Really anything over 50 is going to be a majority, but they're going to have you stay aligned with them by being an interest equity holder and oftentimes continuing to stay out with your company and even run it. Sometimes doing the same exact thing you're doing now. They might send in a management team or they might stay hands off. It really depends on what the components are, the dynamics of what you're contributing, what you want out of a deal, and what your participation will be going forward. The key to that is they're going to try to grow that value, but they're going to lean on you to still be the leader helping to grow the value. And then with your equity participation of that, let's say 20%, when they do trade in that second sale, 5-7 years down the road, you're going to get what's called a second bite of the apple. That means you're going to sell your interest ideally for as much, if not more money than you got in the first sale. And the reason for that is if you have, let's say you held 30%, they triple the value, then your payday will be about the same as that initial liquidity event. If we move past the majority recap, there's also private equity minority recap. That really kind of looks like growth capital. Somebody's making an investment, they're acquiring a portion of your business, usually minority. They're probably not injecting actual staff, but you might have a board or some type of oversight committee, and then they're putting in the capital to help grow your business with their professional expertise, but you still with the majority of the equity ownership and you remain in control. I hate to go backwards here, but we touched on an ESOP. In an ESOP, you can still remain in control. Don't think it means giving up control. Just depends on how you arrange it and what percentage you sell. Another way you can sell the company is through just a merger with a larger entity. Think about being purchased by a strategic buyer. Kind of looks more like a third-party sale, but when you get up into the lower middle market or beyond, or even up into the bulge bracket, then you're going to have what's, instead of a financial buyer, that's your typical private equity buyer, it might be a strategic buyer, which could be a corporate competitor or someone buying you for your specific attributes, paying you a premium because to them, they can capture synergies, they can leverage what you have already across their channels. And quite honestly, let's say if they're trading in the public markets or they already have a valuation based on their operation, they could arbitrage your valuation on day one. So if your business and your risk profile says you're making $5 million and at a 4 to 5 multiple, you're worth $20 to $25 million, they might have established multiple in the 8 to 10 range. So they could take that same $5 million that you're making and simply by acquiring you inherit or your company walks into their risk profile, and that $5 million becomes worth $40 to $50 million magically overnight just because of who they are and how they could capitalize on what you're bringing to the table. A lot of owners dream of this. I'll share it's a minority of the buyers. I think 80% of all sales will be to individuals, about 10% will be to private equity, maybe 10 to 20%, and then about 10% will be to strategics. So you could hope for it. It's just not the common case. You'll know based on where you stand in the industry, how large your EBITDA is. If you're not over $5 million, it's probably not going to be the case. And then finally, kind of what you have in terms of IP or other assets that a strategic will really want to lock onto to make the most of your assets. If we go kind of further up the scale, if the bottom end's liquidation, that's not really attractive. At the other end of the spectrum, there is the IPO. A lot of folks know that going public. A lot of small business owners don't think it's possible. For most of them, it's not. There are ways to go public. We don't do it. We've worked with folks that do it. We've sent donors to folks that do it. There are ways to go public outside of the traditional means. You could go public, for example, from the Jobs Act, doing a Reg A filing or different type of filings built for smaller companies where you could go directly to market. No one's buying your shares and underwriting the offering, but you're able to raise capital. Other folks you'll see will have what's called SPACs, special purpose acquisition vehicles. They could acquire you without having anything in that vehicle, any company, any revenue, any profit, and they could already be listed, or they could take you to list or even uplist to a higher or better exchange once they acquire your company. There's also companies that can do reverse mergers. They take what you have, they buy an entity that's already existing, established, and maybe traded on a different listing site. And when we're talking listing sites, we talk like Pink Sheet Stocks, NASDAQ, I'm just naming a few easy ones, and then up to like New York Stock Exchange. So they're probably going to exist on a lower exchange. We say that Pink Sheets are the over-the-counter stocks you typically associate with penny stocks. They could already have a publicly traded entity that's listed, or they could buy that by buying a shell company. They could fold your assets into that and poof, overnight, or a publicly traded company. When it comes to how you're going to sell or the ways you can sell, there's every variation in between those. Think in terms of, I mentioned a minority recapitalization where a private equity company is providing growth capital. Oftentimes the way they structure that isn't by saying we're going to buy your stock. They'll do convertible debt. They'll say, we'll give you a loan for $5 million, and this is the roadmap of the initiatives this is going to fund to grow your company. If and when we like that debt can convert to equity, where they then become your partner, but they're kind of taking a position where they can take it or leave it. They can choose to move forward with equity if they want to, or they can, take a different position and treat it just as a loan. So everything in between exists. You're not relegated to just one solution. You could even do several solutions. We've sold to third-party buyers that then sell the company into an ESOP. We've sold to private equity companies that are only going to turn around and build it and then sell it into a strategic, or do a roll-up themselves and then take that public. So any combination of these is also often possible. Key for an owner is don't limit yourself by what you think the solution or the path forward is for you, because everything is possible. I gave you the conventional ways to market your company or the conventional transfer channels. There's a lot of unconventional transfer channels, too many to speak about here, and frankly, some of them are more unorthodox, but just as many of those exist as the conventional ones. You could get creative, depends on what your motivation is. Is it to reward your employees? Is it to pay the least amount in taxes? Is it to get the highest valuation despite when you actually receive payment? Every variable changes the equation of what's possible for you. So what you want to do is establish exactly where you're at, look at what your goals are, what your personal readiness is, your financial readiness, and your company's readiness. Evaluate where you stand in the marketplace from a size perspective and from an attractiveness perspective, and then speak to advisors that actually know all the different marketplaces, all the possibilities to say, here's the universe of all options available to you, and don't just choose one and run down that path. Parallel process 3 or 4. Have your financial planner involved, have your accountant involved, have your attorney involved. Look at, given your larger picture of your estate and your estate planning initiatives, your tax planning initiatives, and what your true goals are from a tax standpoint, and what your personal values are for what you want to see for your company and your legacy. See where all of those intersect to give you the outcome you want, because it all can be completely customized. We've developed a tool called the Exit Path Navigator. It's not perfect, but nothing in this world is. It'll give you insights as to what type of exit or transition path can most align with your personal goals, interests, and your values. If you're worried about staff continuity and company culture, some options might not be attractive to you. If you're worried about getting 100% of your money on day one and having a 2-week transition training period and that's it, other paths won't be available to you. But if you can go through what your priorities are, what you value most, what you're hoping to get out of a transaction, and you can rate kind of where you stand in the spectrum, then you can narrow down the types of transfer channels that you should probably focus on. You can still look at the other ones, but because there's such a wide gamut of possibilities, we created a tool to help you reduce the selection set, but at the same time, make you aware of all of the possibilities. Nothing like it exists out there in the marketplace. We've never, like most of our calculators, we haven't seen anything like it or to the degree of sophistication they've been created with. We hope you can benefit from that. That was the intent. We sincerely hope you found this insightful. If you liked what you saw, if it was of any value to you, subscribe below. Feel free to ask any questions and comments. We'd love to see you again. We'd love to give you more content. So do subscribe, follow up with us, and let us be a resource for you. Thank you.